Hello, everyone. Thank you so much for joining us again for another weekly wrap-up. My name is Jeremy Cronemeyer. I'm Operations Manager for Wickham Financial Group. I have Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, what happened in the markets last week?
Yeah, thank you, Jeremy, and thanks for our listeners jumping on the call. I think volatility is just the name of the game. We kind of talked about it. No one loves it. It's not unexpected to have it. So we saw the S&P 500 and the Nasdaq fall up just over 2%. The Russell 2000 was down about 1.5%, and we did see the S&P 500 enter that correction territory down over 10%. But at the same time, kind of a safety trade here, we saw the gold future surpass 3,000 an ounce due to some of that global economic concern, tariff talk, all that kind of stuff, and what it may do in terms of slowing the economy down from its quicker pace we saw earlier in the year or last year. So we saw 8 of the 11 S&P sectors declining, with discretionary and staples falling over 4%. Now, the February inflation, or the CPI number, and the PPI number showed some slight moderation, but we still had some concerns coming out and some projections coming out of inflation expectations moving back up to about 4.9% and long-term expectations moving up to about 3.9%. Now, if we look at U.S. Treasury yields, we did see those end slightly lower than after they were rising a bit earlier in the week over some potential concerns of government shutdown, but that looks like that's been averted at this particular time, or at least that can has been kicked down that proverbial street a little bit longer. If we go over internationally, you did see Russia tentatively support maybe a U.S. ceasefire proposal with Ukraine. We'll see how that's going to evolve. We did see the German Chancellor-in-waiting secure some backing for increased borrowing, some increased spending on defense spending, which is helping to lift some of those international markets that trade at a bit lower valuation than the U.S. We did see Mark Carney, who won the leadership over in Canada's Liberal Party. He won that leadership. And the Bank of Canada also cut interest rates to about 2.75%. Now, Chinese stock indices continue to rally with some policy support rolling out to help to hopefully bolster some consumption that's going on there. Now, the week ahead, I think it's going to be a lot around central banks. We're going to be looking at the Federal Reserve coming out. The Bank of Japan's going to be speaking on their interest rates, as well as the Bank of England. Now, the Federal Reserve is not expected to be cutting rates this week, but they're going to give us some dialogue, maybe some updates on some economic projections, maybe some new dot plots. From a U.S. economic data standpoint, the Atlanta Fed will be coming out with its Q1 GDP estimates, retail sales will be coming out, housing data, regional manufacturing, so on and so forth. And internationally, we're going to be looking to see how GDP in that release of that gross domestic product for the Bank of England is setting up, as well as rates, and the same thing for the Bank of Japan, as well as China. China, they're going to have some releases on industrial production, some retail sales. Jeremy?
Gotcha. Well, Graham, I had a question for you. So I know that history doesn't always, guarantee future performance, but with what's going on in the markets right now and people talking about corrections, what does history show us on corrections?
No, I'm glad you asked that question. It's no guarantee that history is going to repeat itself, but I always say it kind of leaves clues, has some sort of rhythm to it. So if we go back to 1929, I think we've had about 56 different corrections. Now, 22 of those corrections, of the 56, did morph into a bear market. So that's a drop of 20% or more. But we're looking at about 34 of those were corrections of about 10%. Corrections are very usual. You usually get a correction every year, right? Bear markets aren't that normal. But the interesting thing was, if we looked at the severity of those corrections, the corrections were down about 13.8% on average and lasted about 115 days. And if my math is right, I don't think we're quite 30 days within the correction on the S&P, if we're just using the S&P as an example here. Now, if we look at bear markets, And that's where we're seeing a 20% plus correction. Those have fallen a bit more. I think we're looking at about 35.6% drop on average in a bear market, and a bit longer amount of time for that to kind of move back up into the positive area. So again, I don't know if that provides any peace of mind, but we do like to look at history to kind of give us some sort of guide of what possibly could happen. So we're always making good business decisions, even though it's not comfortable, and not emotional ones, as we go through this roller coaster, as we go through this volatility that we're seeing and already did expect to see this year.
Gotcha. Well, Graham, we always appreciate the
You got it.
information and the expertise. And thank you to our listeners for joining us every week on the weekly wrap-ups. And we'll see you again next week.
Take care.